I thought we'd start out by asking you about the current environment with endowments. A lot has been written about some of the challenges in the endowment world with respect to rebalancing portfolios and the exposure to long-term assets, private equity, and so forth.
Sure.
What's been going on at Cornell?
Well, Cornell is in the same situation as many other endowments, from the standpoint that we had a very robust alternative asset program within the endowment. And like most schools, it was a very robust source of returns. And when you had a situation like you had over the last 12, 18 months, where you had a dislocation in the marketplace and all your correlations go to one, all of a sudden, you discover that, that source of returns, the illiquidity of it in a very dislocated market could be a source of pain. And right now, I think every endowment is going through a discussion as to how is it that we construct a portfolio, or how should we be thinking about asset allocation in the context of risk, return, liquidity, illiquidity. Many of the top-tier endowments like Cornell, rely significantly upon endowment income to fund their operating budget. At Cornell, in comparison to some of our peers, we only require 13% of the operating budget of the university comes from endowment income, vis-a-vis other schools where it was in the 30s and the 40s and the 45, almost approaching 50%. So when you have a situation like we've had over the last 12 to 18 months, and assets are down, when things are tight from a liquidity perspective, it creates a lot of friction within your university from the standpoint, how are you going to meet your funding requirements? Because as you know, these schools it's a competitive business in terms of academic institutions. There are requirements in terms of scholarships. There's requirements in terms of capital raising. There's capital funding for different institutional requirements, such as buildings, libraries, research institutions, and the like. And when that hole is present in your budget, it creates a lot of friction. So what you're seeing right now throughout the endowment universe is a series of cutbacks, paring back on capital expenditures, paring back on staff, going through a real rigorous assessment as to what staffing needs are, what staffing requirements are. So that's what's going on in the endowment foundation universe. I think that people have recognized that this asset class has been a source of return, but also the illiquidity of it could be a major pain point in a very dislocated market.
Do you expect that going forward, the reaction from the LP community, whether they're endowments or pension funds or foundations, will be to change things structurally for the long term in terms of how they look at the alternative asset class?
I think people are having those discussions right now. What actually happens, I don't know. But I think that there has been I can tell you from a Cornell perspective, there's been a very rigorous discussion as to how much illiquidity should we have in our endowment model, and what is a trade-off that we're willing to take in terms of liquidity versus illiquidity and returns. So I think people are going to have those. People are having. I know if Cornell's having those discussions, other people are having those discussions, and I think that given private equity and its nature, right? There's not too much that you can do right now to that asset class unless you want to sell out your program at a deep discount and start from scratch. So people are going to make modifications at the edges, but I think long term, yes, there will be some changes. But look, if the market snaps back, if the market continues to snap back with the strength that it has over the last couple of months, then people may table those discussions. But if we're in an environment where we have single-digit returns and it's sort of a sideways market, I think a lot of people will make significant alterations to their endowment program, to their alternative asset composition of their endowment program.
Okay. And you've made the trip out here to Hong Kong, so Can we take from that the fact that Cornell and maybe endowments in general still have a very global perspective on alternative investments and an interest in this part of the world?
Yes, absolutely. I mean, I'm here not only for the conference from the perspective of getting information, but I'm also here to meet with my existing managers who are out here in the region, and also to have an opportunity to meet with prospective managers who are out here in the region. I think that we take the long-term view. I mean, Cornell's been private equity since 1979, and a lot of our other peers have been in the asset class since the late 70s, early 80s. And yes, there is a continuing desire to remain committed to the asset class, although we may make changes at the margin. But nonetheless, we are committed, and Asia is a significant portion of global economic activity. Asia is a significant, or is considered right now, a part of the world that has a lot of interest. And given what's going on in China, and given some of the things that are going on in other Asian markets, it behooves us as an institution to maintain a presence and to have our fingers on the pulse of what's going on in this part of the world.
Okay, great. And in terms of the various opportunities to deploy your capital going forward in alternative investments, what specific sectors or geographies look particularly attractive to you? Distressed investing, secondaries, LBOs, venture?
Sure. I mean, given the environment right now, I've been saying this to my boss and others on my board, and my boss and others in the community. This is an environment where a special situations orientation or a focus is important from the standpoint that we're probably going to be in a very sloppy market near term meaning for the next 2 to 3 years, maybe even 5 years, and it requires you to think about the asset class in a different way. And I don't think that, a classical, although there's a place for classical LBOs in one's portfolio, I don't think the environment near term is best suited for classical type LBOs. And I think that, secondaries, there's a tremendous opportunity there. I think special situations like corporate finance distress, I think IP royalty funds or things that are sort of venture-like returns without venture-like risk are very important. I think, focusing on managers who are capitalizing on areas of opaqueness and inefficiency is important right now. So I think that it requires one to be a little bit out the box, think a little bit out the box, and go for names that are not necessarily household names, but are strategies that can generate tremendous returns and keep one's program sort of robust until the marketplace sort of normalizes and other asset classes that have traditionally done well, like buyouts, come back into vogue, if you will.